12 steps to buying an investment property. On this channel, we've done so much content about where to buy your next investment property. But in this video, I'm going to tell you how to buy your next investment property. In one of the first videos of its kind, we're going to release the step-by-step, the 12 steps that you need to take to buy your next investment property. Let's go straight into it. Number one, your starting point is to work out, what can I actually buy for? Now, to do this, pick up the phone or jump on a website and start speaking to a mortgage broker. Ideally, if it's an investment property that you're looking at, speak to someone who knows about investment property lending. Some of the lending techniques here are a little bit different, and it's best to structure your finances properly from the get-go if you want to build a property portfolio. If you need someone to talk to, jump in the description below, hit the link there, and speak to one of our team who'd be more than happy to help you with this part. We are the first starting point to help you work out your budget, what you can buy for, the rental yield you should be targeting, and what you can actually purchase an investment property for, and if you can, multiple investment properties and how you want to split your budget up potentially if you're looking to buy in different locations, and whether you have some equity within your existing portfolio, whether you want to take some of that out to purchase a property. When you go and buy, the decision point as to whether you can buy an investment property, what the mortgage broker is going to be working with is a function of three things. Firstly is your credit history okay? Have you been paying your bills on time? If you go and meet that criteria, you'll be okay. The second thing is your borrowing capacity. This is your income and expenses, and you need to be in a position where you're effectively saving money every month to show that you can meet your payments and everything that you need in life, and you have some leftover money that you can go and invest. And the third thing is your deposit. Do you have some savings that you can use to contribute as the deposit for the purchase price? At a bare minimum, you need 10% of the actual purchase price of what you're actually purchasing. You know, that'll cover for around a 5 to 6% deposit and another 3 to 4% to cover the transaction costs. Ideally, you have at least 15%. And if you can, a 25% total deposit will ensure that you have no mortgage insurance costs. So 10% minimum of the purchase price. So if you're buying for $400,000, you should really start looking at a minimum deposit amount of about $40K. Ideally, you have 15%, so $60,000. And if you have 25%, so roughly $100,000, then you're going to be able to do it without any mortgage insurance. You'll need a 20% for the deposit plus about 5% for all the transaction costs involved. That's just a really high level. And behind me, I just show you some of the emails that we send to our new investor clients, helping them grow, build, and scale a property portfolio. This is the advice that we give them that really starts their journey to actually purchasing. Step number 2, you got to run your cash flow on a property investment. What you really want to know is what your before and after position looks like. What happens to my portfolio? What happens to my cash flow? What happens to my finances after I actually purchase this property? Most property investments in Australia are actually going to be negative cash flow. That is, when you go buy the property, it's going to cost you a little bit of money every single month to hold that property. It's because interest rates are really, really high at the moment. And if you pay principal and interest on a loan, rather than just paying interest only, then your repayments are going to be higher and it's going to drain a little bit more cash flow out of you. You got to be modeling out your cash flow position because it's a starting point to working out whether you can actually afford this investment property. If you find a property investment is going to drag $10,000 a year out of your income and expense situation, but you don't have $10,000 a year left over after meeting all your expenses, then you're probably not going to be looking at that property investment. So you want to run a cash flow position. Really, really roughly, this is what it looks like. The income of a property that you're going to go and purchase. Let's just say you're buying in Darwin for $600,000 with a 7% rental yield. That property is going to generate roughly $42,000 in rental income. That's just 600,000 multiplied by 7%. That's the rental income that you're going to get. You're going to have a bunch of expenses. You're going to have council fees, you're going to have insurance fees, you're going to have water, you're going to have property management expenses, repairs and maintenance, a bunch of little things that you need to factor in, and sundries, I guess. And the main one is interest on your loan. So you're going to add in all of these expenses up and work out what your net leftover position is. Then in your own cash flow spreadsheets, you can add in another couple line items. One line item is depreciation. This doesn't impact your cash flow day to day, but when you go and do your tax returns at the end of each year, you get to include a depreciation amount on the building component of whatever property investment you purchase. If you're buying something brand new or close to new, you might get a negative $10,000 depreciation expense that you get to claim when you go and do your taxes. That helps your after-tax cash flow on your property investments. So that's how you calculate the cash flow impact of purchasing a property investment. You may also like to do a budget on yourself to begin with as well, because you kind of got to know as to whether you can meet your expenses. You know, what your own household income is, what your own household expenses are, and what's left over every month. By working out what's left over every month, you're going to kind of work out how much spare cash flow do I have to be able to invest in property. If you find that you're, saving $20, $30, $40, $50, $100,000 a year, or a ridiculous amount a year, you're going to be like, hey, it's completely okay for me to go buy a property investment that loses, a couple $1,000s a year, or loses nothing if you're buying in Darwin, or it could actually shape where you actually go and purchase. If you purchase in Melbourne right now, for example, you're going to have a negative cash flow, which if you don't have surplus income, you're not going to be able to go and meet. So it's going to help you direct what you're actually looking to buy. Your mortgage broker, running a budget, and running a cash flow are the three things that you need to work out exactly what my finances are going to look like before and after purchasing. Okay, the next step is the juicy bit. Property investing is really about two things. One, getting money, which is step one and step two. And two, what do I do with the money that I get? Where do I place it? What should I buy? So this is where you start coming up with the suburbs and the areas that you want to look at. This is the really, really tricky part. This is the part that whenever I go to a wedding, whenever I go outside, and whenever I meet somebody who knows me, the conversation quickly goes here. Reedham, where should I buy? I can't sit next to someone at a wedding now without somebody asking me. Be like, hey, now that you sit next to me, where should I buy, buddy? Everyone wants the answer to this question. It's also why we've done so much content around it, to help educate you where other people are buying, where I'd buy, and some potential options for you to look at. Check out some of those videos. It can really fast forward your research for you instead of looking at a map of Australia being like, instead of walking around the street, going on your little walk every night, being like, hey, what about that property? Holy moly, it costs $2.5 million. I can't buy that. There's properties all around Australia. You can buy from, starting point $200,000 somewhere in Australia, all the way up to, 10, 20, $30 million. You can invest all the way up to that point. There's a huge range of properties out there all across Australia. Do not restrict yourself to your own backyard. Look outside where you are from. And if you're in Sydney in particular, there are much, much better places to invest. I'm a Sydney-sider. I own property only in Sydney by and large, or the majority of my property portfolio, and I'm still telling you that. There are much better places to invest than Sydney right now. In fact, in our top 25 suburb list that we came up with in this video, I explicitly say that Sydney is an area to avoid. It is not out of self-interest. I don't own in Darwin. For those that are interested in being like, hey, does this guy own in Darwin? He's pumping Darwin a lot. It seems like he really owns in Darwin. I don't own property in Darwin. I'm just following the data breadcrumbs and sharing with you everything that I know as openly, as transparently, as honestly as I can to help you make decisions. So how do I work out where to buy? Use these three data tools to help you. Higher than average growth, Microburbs, or DSR. If you want to find out where all the hotspots are, DSR will teach you that. This video is particularly useful for how to find out hotspots. HTAG will help you find the data, all the research into specific suburbs. I really like this tool. And the last one is Microburbs. This one's a free tool. If you don't want to spend any money on it, you can find a lot of answers about a particular location using Microburbs. And in particular, it helps you understand the socioeconomics of a particular area, the incomes of that area, whether there's public housing, what the type of profile of tenant is, things like that. Microburbs is particularly useful. So there's three tools that you can use, and watch some of the content on this channel. It will really, really help make it really simple for you, because I've just spent countless hours going through all the economies all across Australia, going through all the suburbs, going through all the data, speaking to so many people, or compiling it all together, making it as simple as I can for you. That could be your starting point. Go through those suburbs. The fourth thing you do, now that you've worked out where you want to look, it's time to go shopping. It's time to start looking. Yeah, it's fun time. Or is it? This is the part where you can feel a little bit anxious. You can be like, holy moly, now I know where I'm looking. I've got some focus. focus in on your suburb selection criteria. Once you've narrowed it down, get to know that suburb as well as you can. Do your research using these data tools. Spend as much time looking into a specific suburb. It is much, much easier to do this once you only have 3 or 4 suburbs that you're actually looking into. That can help you frame exactly what to do next. You don't need to spend all your time looking into 15,000 areas and getting all like, what do I do? There's too much information. It's much easier once you've narrowed it down to a few suburbs. Go on Real Estate Domain, start looking at those properties, and you can start finding a few properties that might suit what you're looking for. Things that look investment grade. If I'm a property investor buying in Darwin, for example, I probably want to pick something very family-centric. It's a transient location. I want to pick something that's a little bit simpler. If I'm buying in Melbourne, I'm quite happy buying an older home, noting that there's so many people in Melbourne, there's so much housing demand there, and I can get a bit of a price discount buying an older home. And if anything goes wrong, it's going to be fairly easy for me to fix up because there's so many tradespeople there. It's just a market that's quite familiar to me. Step number 5, this bit is up to you, very, very much an optional sort of perspective. I probably don't need to touch on this, but if you want to start making some phone calls to all the real estate agents, you can start getting access to some off-market deals. Pick up the phone, call the real estate agent, say, this is your budget. Maybe don't tell them the exact budget, but a framework of what you're looking for, this number of bedrooms, this area, this type of home. Do you have anything available? You might be able to get access to some off-market deals or some pre-market opportunities too. Okay, now that you've worked out what you want to buy, you might have a couple properties now, not just suburbs. You've got a couple properties that you want to look at that you've shortlisted as properties that I want to go and purchase. You want to do something called comparative market analysis, CMA. What a fancy word that is. This is how all properties are valued here in Australia. Valuers use this technique to work out the value of a property. They simply look at what is trading in the market, what has it sold for. Here's a little tip of how I do it. I'm going to actually just show you how I find sold prices. So I'm looking in a suburb called Randwick right now. I go into the sold property section of Real Estate Domain and I'm looking for a house. I'm going to say I want to pick something in the last 6 months that has 3 bedrooms, 3 to 4 bedrooms plus, and has a land size of at least 300 square meters. Okay, what you quickly find out is this is really, really annoying to do. Everything doesn't have existing sold prices written on it, which make it really, really difficult to work out where do I actually want to invest. So what do I do here? The next thing I go and do here is find out what this particular property sells for. Is I click into it and then I put in the price filters of what I'm looking for. Let's put in a price filter. I think this house would sell for $3 million. I picked a very expensive area. Okay, let's put in a price filter of 3 to 4 million. This property price pops up. So let's go add in. So what you can do once you've done this is then start toggling the filters up and down to go and work out exactly what you can purchase for. You can use Domain to go and do this to work out what the sold price is. You can also get property reports from CoreLogic that give you the comparables of the property that you're looking for. Your mortgage broker can get this for you. So if you've got a mortgage broker that's investment savvy, go and ask them, be like, can you go and get me some property reports for this property? We do this a lot for our clients. We help them through their research process by giving them access to property reports that give them the comparative market analysis that they need. Okay, so now you've worked out what property you want, you've worked out what you think it's worth, you come up with a bidding criteria for it. Be like, look, I'm happy to spend, $500,000 on this property investment. What you go and do next is you start negotiating. You go to the agent and you start making an offer. You may put terms in your offer, like I need build and pest, I want access to the property to organize tenants before settlement, and I need a 28-day settlement period or a 42-day settlement period. You have to put in the terms of your offer. It probably makes sense to put the offer in writing and say, this is what I think the offer should be. This is why I'm offering it. And then pick up the phone, call the agent, let them know, and start negotiating. Quick little negotiation tip is if you start negotiating for a property that's for $500,000 $500,000 and that's your maximum bid, you might want to start roughly 10% below that, call it $450,000, and then start inching your way up. You probably want to inch incrementally, so you might go 450 to 470, and then once you get to 470, it might be smaller bids, much like an auction, like go from 470 to 475 to 476, etc., like an auction where you have bigger increments to begin with and then smaller increments going forward as you get closer and closer to your purchase price. So that's the contract review process. Now, once you've done all of this, it's time to go and get your property signed up. You probably want to give it to the lawyer as well to take a look at and look at the contract. I've looked at contracts so many times that these are the things that I'm looking for. I'm looking for the title search and seeing if there's any weird easements on it. I'm going through the planning certificate. I'm going through the sewer diagram, and I'm looking at the special conditions in the contract and seeing if there's anything unusual there. But your solicitor will feed into that process and help you work out exactly what is in the contract and if there's anything unusual that you need to know about. There are some curlies that we've seen in the past. Then you go and organize your build and pest. This is typically done during your build and pest period. When you go and purchase, you often have 7 to 14 days to go and do this. Call a local build and pest person and get them to go and do a thorough review of the property that you're looking at. And also get your property manager here to go and inspect the property and take a really good look at it. If you're available, maybe you want to go and do it yourself. A lot of our property investor clients, really savvy ones, they go and actually go and look at that property investment. And those that don't, they call their local property manager and they go and do it for them. Now that you've got that all sorted, you go give the contract of sale that you've gone and purchased for and signed. So I'm up to step number 10 here, the unconditional financing process. Give that contract to your mortgage broker and say, mortgage broker, go get me my approval. I'm ready. Your mortgage broker is going to do a quick valuation on the property. Most of the time, it's just a contract of sale valuation. They just accept the contract, and then they'll get a rental appraisal of you or your real estate agent, and then they'll turn that pre-approval that you have into a full approval. Step number 11 is you're ready for settlement. You have got your property manager ready. Your property manager ideally has already found you a tenant if your contract allows you for it, or is getting ready to list the property for rent from the day you have purchased it. Or maybe there's already a tenant in place there because you're buying a property from another investor, which is very, very common at the moment. And finally, you're at step number 12. This is about settling on the day of settlement, having all of your money in the right accounts and setting up your finances and the structure of your property investment so it's ongoingly managed. Things that I do commonly to have my insurance policy dates, setting my calendar, to have the rates notices and any other associated water notices and things like that forwarded straight onto the property manager so they can take care of all of that. So that is the really high level, step-by-step, everything you need to do to go and buy a property investment. It's not just where to buy on this channel, it's how to buy it too. This is your guiding light, the step-by-step of everything you need to do to go buy your next property investment. If you found this video useful, do me a quick favor and hit that subscribe button. Help me on my journey to keep producing content that helps you make better financial decisions and grow and build your property portfolio.